Okay guys, third video, offset versus redraws, and this is the one that talks about tax deductibility. Up front, not an accountant, right? So anyone that's watching this video and then wants to go and do something off the back of it, go and show it to your accountant and make sure that at the end of the day, they're aligned with what I'm actually talking about here, because I'm not qualified to give tax advice. What the purpose of this video is to give you an understanding from a lending perspective, the different options that are available and the potential impact it can have from a tax perspective. So as I mentioned in the first video, the biggest difference between an offset loan and a loan that's got a redraw facility, or the consideration around which one's the right one for you, really requires you to do some forward thinking. So what do I mean by that? Well, let me give you an example of a client that would have to make this discussion, or we would have this discussion with. It might be, let's call it a young woman, 25 years of age, that's about to go and buy her first investment property, to move into. She's sick of paying rent. She feels that she wants to have her own space, decorate the property the way she wants to decorate it. But she's single. She doesn't have a partner, and she also wants some independence. She wants to have done something on her own. But the thing is that she also knows that this property that she's about to purchase is probably not going to be her forever property. Her life's going to change. She might meet a partner, right? She's going to start a family, etc. But she has in the back of her mind, or has this thought that at the end of the day, if she was able to hold on to this first property as an investment, as part of a portfolio, because everyone sits there and says, oh, I'd love to have a property portfolio. I'd love to create wealth through property. It's so easy, etc., etc. So you need to sit there and go, okay, well, if I would like to create some wealth through property, and this first one that I'm buying may be held onto, I want to at least know that I've got the option of holding onto it as an investment property. This is where it's really, really relevant, right? So making the decision. So we're going to use, again, we've got basic loan amounts here. But let's just turn around and say, right, we'll use a 3-year period. In my last example, I talked about when you had $10,000 from your tax return and you chucked it into your loan at the end of each year. Let's think about over a 3-year period, right? So that young girl has turned around and she's bought her first 2-bedroom apartment. She bought it for $150,000. I don't know where she lives to get it for that. But basically, by making standard principal and interest repayments over those 3 years, her loan balance just has come down each and every month, and it's at 90 grand. But she's also put 10 grand every year from her tax return in, right? So she's gone and put an extra 30,000 extra repayment. So she's gone and reduced her loan balance down to 60,000. And she's done it again by putting just standard repayments that have reduced it from 100 down to 90, and then a further $30,000. And her loan balance is now down at $60,000. Now, the extra repayments that she paid in was 30,000. 10 was the standard that she needed to make, but she's paid an extra $30,000. And she comes to the point and she's met a bloke, and at the end of the day, they turn around and they go, we want to go and get ourselves a property out in the burbs that we can start to build a family in, right? And the 2-bedroom apartment in Footscray ain't going to cut it. So they turn around and go, right, well, what do we need to do? We need to turn around and be able to come up with a deposit for the next property. Where are we going to get the money from? Well, she's poured all of her cash in. He's coming to the party. He's given her a little bit as well. He's come and saved up a little bit as well. But our clients turned around and said, well, I've put all my extra cash into the loan, and I've put $30,000. I'm going to redraw it back out. So that $30,000 can be redrawn back out and used towards a deposit on the next place, right? How neat's that writing, right? Deposit on the next place. What's really important to understand is this house that secures this loan, right? Just because she's redrawn that money back out doesn't mean it's now an investment property. So what's important to understand is this $60,000, right? This $60,000 now becomes, the interest that you have to pay on it now becomes tax deductible. So what do I mean by that? Let's just say the interest repayments per year on that $60,000 is $2 grand. That $2,000 can come off her wage of $70,000 when she does her tax. So instead of a $70,000 wage that she pays tax on, she would now only have to pay tax on $68,000. To complicate the matters, she also would earn rent of $1,000, right? So at the end of the day, she would have to add that back on, but she now only has to pay tax on $69,000 as opposed to $70,000. So it stands to reason, right? A lot of people sit there and think, well, hang on a minute. I'm going to go and when I redraw $30,000 out, won't I be able to claim interest in this manner on the full $90,000? because it's an investment property now. Well, no. The important thing to understand, it's around the purpose of the borrowings. This $60,000 can be considered to be investment borrowings because that's the balance at the time that she has gone and bought this new property with her partner. But this $30,000 was used for the new place that they've gone and bought out in Montmorency. It's for personal use. So you can't claim that $30,000 as a tax deductible debt. So you sit there and you go, okay, cool, well, that's fantastic, right? She's gone down that path and she took out a principal and interest loan, and that's the scenario. What's the alternative? Well, this is where the offset becomes a real benefit. So using this example, I'm also going to use an interest-only loan as an example, like repayment. In this situation, right, our client doesn't need to make a principal reduction with every repayment. So she's not going to reduce the $100,000 down to 90 at all. It's still going to be at 100. And instead of putting it into the loan, she puts that $10,000 into the offset. She also puts the $30,000 over 3 years into the offset as well from her tax returns. So she now puts $40,000 and she's got that sitting in her offset account. Right. So the amount of interest that she would have paid would be similar on this scenario as she would have in this scenario. Why would you do this? Well, the tax department now turns around and says, you never reduced this loan balance. So what is now an investment property has a loan balance of $100,000 as opposed to $60,000. You've got a bigger investment loan, which means fundamentally the tax return that you would be able to get, or the tax deductions, is going to be higher. So you're going to have more in your tax return. So instead of $10,000 each year, you might have $11,000 each year if you went with this structure. So it's important to understand you've now got a bigger investment loan. Was a home loan, now an investment loan. You've also got $40,000 sitting in cash, not sitting in redraw. And because you're pulling that $40,000 out of a bank account, that's cash. Your loan, your home loan, is now going to be $40,000 less than what it would be in this situation because you've redrawn it back out. You've redrawn it out, but it's still debt. This deposit's coming from debt. This deposit is coming from cash. Now, your overall debt position on the investment property now and your home loan is going to be the same. You're still going to have the same amount of debt. The difference being is you're going to have more investment debt and you're going to have a lower home loan debt because you've got a bigger deposit paid by cash. Now, I hope that explains it. Fundamentally, at the end of the day, that's the biggest consideration. It doesn't just have to be our young girl that's bought her first 2-bedroom apartment in Footscray. It could also be someone that's in the second or third property along the journey. But the key point being that they sit there and they go, the house that I am buying, I would like to consider and hold it as an investment property when I go to upgrade to the next one. If that's a consideration or something that you're thinking about, that's where these decisions around what's the right loan structure is important to get right from the start. And that's our role as a business to help guide you through those options.